Mutual funds, index funds, and ETFs are three different investing vehicles or instruments. We all hear about them quite often, and a lot of people mix them up, just like I did when I started my investing journey a long time ago. So I know for sure that it can be confusing, but after this video, everything will become crystal clear. At the start of my investing journey 15 years back, I found that mutual funds had a high management fee and the money will be paid for management irrespective of whether the fund makes profit or loss. Afterwards, I found that ETFs were not aligned with my investing philosophy either, and I was tempted to make emotional trading decisions. So in the end, I found that index funds are the best fit for my long-term investing game plan and philosophy. Therefore, I want you to know the key differences between mutual funds, index funds, and ETFs, since I believe that it will help you in going for the option that is more congruent with your own investing goals. So if this sounds interesting, keep on watching the video. Hello, I am Dr. Subayal Khan from Subayal.com, and today we will understand the difference between mutual funds, index funds, and ETFs. Why were they created? What makes them different? And most of all, what are the advantages and disadvantages of each one of them? Apart from that, we will also compare them along 4 key dimensions which are very important to consider before making an investment decision. Because at the end of the day, we want our investments to give us better return, isn't it? So here are the 4 key dimensions along which we will compare them. Number 1 is convenience, meaning how much of your time goes into overseeing or managing all 3 of them. As we know that time is money and time is a non-replenishable resource, so we must use it wisely. The second one is risks. So how much all of them compare as far as mitigating the risk is concerned. And this risk is associated with volatility caused by news and other factors. And the third one is leakage, meaning how much money do you pay for managing them. And the fourth one is human psychology. So how these instruments prevent us from the herd mentality, temptation to get caught into shiny object syndrome, or even worse, go down the chaotic rabbit hole of revenge trading. But before we start, kindly go ahead and hit the subscribe button. My channel is all about investing, personal finance, and high income skills. Also hit the bell and select the option all, since only then you will be able to get the notifications of the upcoming videos on time. I'm sure that it will help you a lot. So make sure to subscribe and hit the notification bell for new videos every week. So let's start now. We will start with mutual funds since they have been in existence for the longest time, way before the index funds and ETFs were created. The mutual funds were created in 1800s. So the main reason for their creation was to allow investors to free up their time by allowing the fund managers to pick different stocks for them and package them under the umbrella of a mutual fund. Therefore, a mutual fund is simply a bucket that contains different stocks which the fund manager picks, and depending on his competence and knowledge, he allocates a specific percentage to the stocks of different companies whose shares are bundled together in a mutual fund. Now, why are mutual funds beneficial? They are beneficial because even though a mutual fund might contain hundreds of stocks, you don't have to go through the hassle of buying all of these stocks separately and press the button to buy them. Pay the trading commission each time, and also you don't have to spend your most valuable resource, which is time, to decide which stocks to buy and which not to. And don't spend your mental energy in deciding how much funds to allocate to each stock in your portfolio. So the mutual funds are beneficial because they make investing more efficient. Also, when you invest in a mutual fund, you get the ownership of all stocks contained in it instantly, in the blink of an eye. This helps you in diversification, which is the strategy mutual funds use to reduce the risk due to market volatility. So all your eggs are not in the same basket and your money is spread over a lot of different stocks handpicked by the fund manager. So even if a stock crashes, it won't be a disaster since the stocks of each company form a small portion of the mutual fund portfolio. Most of mutual funds contain at least 90 stocks. Therefore, it would be difficult for you to come up with this level of diversification on your own. So it might be a good idea to invest in a mutual fund and let the fund manager manage it for you professionally. When a fund manager selects the stocks for the mutual fund, it is called active management. But the expertise of a fund manager comes at a cost, and the fee for managing the fund can be quite high. So, as a return for actively managing your funds, the fund manager typically charges 2% management fee. It means that if you invest $100,000, the fund manager will charge you $2,000 per year to manage it. However, the issue is that even if the fund manager does not give you good returns in an year, and even if your account balance goes down, the fund manager will still charge you a 2% management fee. In this way, it might happen that over the course of a few years, you might end up with less money, but the fund manager will still pocket millions of dollars in terms of service fee. One remarkable interesting finding which led to the creation of index funds was that even if the fund managers do well for some years, it is hard for them to sustain it in the long run. But at the same time, you will still be paying the management fee, which will lower your balance. So most of the mutual funds are not worth investing since the costs and fee can really add up. So now let's see how mutual funds do along the dimension of convenience, risk, leakage, and human psychology. So as far as convenience is concerned, they save the investors time and they can invest in it with the click of a button, and they don't have to worry about the stocks which they have to pick. As far as the risk is concerned, the risk due to volatility is suppressed by diversification, but the high management fee can eat up on the profits. The human psychology can also add the risk since fund managers do have emotions. Now, looking at the dimension of leakage, as mentioned before, they do have a high management fee which can add up over the years and considerably reduce the profitability. Also, human psychology plays a role and it increases the risk since active management means human involvement. And it has been seen that fund managers are definitely not immune to emotional decisions which can add up to the risk. To mitigate these shortcomings, index funds were created, which were nothing short of a revolution in the world of investing. A gentleman named Jack Bogle got terribly upset of mutual funds ripping people off, and out of that frustration he created a new category of funds called the index funds. The index funds are not actively managed. Now you might be wondering, where did the term index come from? So the answer to this question is the index funds are passively managed, and index funds use a fixed formula which removes the need for a fund manager to manage the purchasing decisions of stocks. And that formula is simply based on an index. And this is where the term index comes from. And an index represents a sample of the stock market and was formed as an investing tool for quickly gauging the performance of stock market. So instead of observing thousands of stocks individually on a daily basis, one can simply look at the index to see how the stock market performed that day. The first index fund was created by Jack Bogle, as I mentioned before, in 1970, and it tracked the performance of S&P 500 index, which is one of the most used indexes in the world. The fund buys all the stocks in the S&P index. The fees are drastically lower since we don't have to pay a fund manager to manage the purchasing decisions of stocks. An index fund clearly mentions that it tracks an index, and it also mentions the index which it tracks. For example, if we visit Vanguard.com and we search for VFIAX, it will be mentioned that it is an index fund, which makes it crystal clear that it actually is an index fund. Also, it states that it tracks the Standard & Poor's 500 index, which is a widely known benchmark of US stock market performance. So now we know the difference between a mutual fund and an index fund. The Vanguard S&P 500 index fund only charges an annual fee of 0.04%. And the effectiveness of an index fund can be gauged from the fact that in 2008, Warren Buffett challenged the hedge fund Prodigy Partners that including fees, cost and expenses, an S&P 500 index would outperform a hand-picked portfolio of hedge funds selected by Prodigy Partners over 10 years. Buffett bet $1 million that They couldn't outperform the simple index. Don't get confused by the term hedge fund now. The point is that hedge funds are actively managed just like mutual funds. So the bet pit two basic investing philosophies against each other, passive and active investing, and this is what we want to see. The S&P 500 index fund chosen by Warren Buffett gained 125% over 10 years, while the 5 hedge funds picked by the firm Protege Partners added an average of about 36% only. Even though the hedge funds got off to a flying start, and each one of them beating the index fund in 2008, then the roof fell in. As Warren Buffett said, the S&P 500 won every year after. And this shows the power of index funds. Therefore, evaluating the index funds along the 4 dimensions, we conclude the following. Number 1, they are as convenient as the mutual funds as we don't have to make the purchasing decisions ourselves. Number 2, they are much less risky since they are immune to human emotions and based on simple philosophy of mirroring the index. Number 3, many index funds have expense ratios well below 0.20%. Number 4, the human psychology does not play any part in the index funds. Therefore, if you have a long-term investment philosophy, then surely index funds are the way to go as the data suggests. Now, we move to the next investment vehicle, which is ETFs or exchange traded funds. So ETFs were created 15 years after the first index funds were created. They are similar to index funds, but they have one main difference, and this is, in case of index funds, one can only buy and sell shares once a day. But with ETFs, one can buy and sell shares when the stock market is open as many times as you want. So even though ETFs are not a stock, one can buy and sell them in the same way as stocks. Sometimes the term ETFs and index funds can also be used interchangeably, even though they are both different investment instruments. Now, ETFs and index funds are exactly similar in the sense that if you want, you can either invest in the S&P 500 index or else you can invest with the ETF like the SPDR S&P 500 ETF. So both of them track the S&P 500 index. Both will give you the same return if you invest your money in both of them in the same way, meaning equal amounts at same time. Now you might ask me a question, shall I go with the ETF or index fund? Or does the 24/7 tradability which ETFs offer over the index funds worth choosing them over the index funds? The answer to this question is, during the last 20 years, I have observed that ETFs can have a negative impact on your long-term investing success because the 24/7 tradability like a stock will psychologically challenge you. And when you see it moving up and down on a stock chart, it will develop a temptation to make impulsive buying and selling decisions. The human tendency to engage in a gambling-like behavior contradicts smart investing. So I will definitely go for the index funds instead of ETFs, since they are exactly the same thing, but index funds shields you from emotional trading and removes the temptation to gamble with your hard-earned money. Also, index funds have one more advantage. In case of index funds, you can set up a fixed recurring amount which will be deducted from your checking account, and you will automatically purchase shares of the index fund each month, and there is no extra fee for doing that. This free features makes the index funds the best investment instrument in the world. ETFs don't offer this feature, so if you want to invest a fixed amount each month, you better go with index funds. Meaning you have to yourself buy shares of ETFs each month, and that can be costly since each time you buy shares of an ETF, you have to pay the trading commissions. Therefore, evaluating the ETFs along the 4 dimensions, we conclude the following. Number 1, they are as convenient as mutual funds and index funds as we don't have to make the purchasing decisions ourselves. And the shares of an ETF can be bought and sold 24/7, which makes them more flexible than the index funds. Number 2, they are much risky since they can develop a temptation to make impulsive buying and selling decisions. Number 3, the fee of ETFs can have expense ratios even lower, such as 0.10%, which is almost half as compared to the index funds. Number 4, the human psychology does play a part when you invest in ETFs. I hope that you like the content of this video. If you are new to the channel and will like to see more beginner-friendly info on stocks and investing, press the subscribe button, hit the bell and select the option all so that you can get notifications of upcoming videos as soon as they are released. So I look forward to seeing you in the next video. Bye.